Last year, I ran a session with high school students about startup pitches. The challenge was that students have so little background on how investors and startups work that required too much lecture. This year, I want that background information to be available up front, letting the session be more hands-on. What follows is an introduction to venture economics and startup pitching, both as a presentation video and also a blog post. I studied computer science at NYU and robotics in grad school at Carnegie Mellon. I worked on bomb disposal robots at iRobot before starting my first startup backed by Y Combinator. And then I worked in engineering at Facebook and product at Dropbox. My second startup was acquired by Lyft. My first angel investment was in cruise automation, and I founded a new VC fund, Tango VC. And I also just founded my third startup, Attention AI. Different types of people invest in startups. Often founders will get friends and family to invest. They're low sophistication, investing their own money because they like you. The first concern is to make sure this unsophisticated buyer understands that startups are high variance and have a good chance of being worth nothing. The second concern relates to rules from the Securities and Exchange Commission, the SEC. In short, only take money from accredited investors, which essentially means having enough money to lose. Angels are sophisticated but still investing their own money. They should already understand startups and their risks. They are almost certainly already accredited investors. The key difference between VCs and angels is investing other people's money or your own money. Venture capitalists raise money from limited partners, LPs. They are limited because they have no say in day-to-day investing decisions. VCs have partnerships that decide how to invest. This means convincing a few people to invest. VCs will have a lot more money to invest than angels, so larger funding rounds focus there. To understand what convinces VCs to invest, you need to understand the economics of their business. That means understanding carry, illiquid returns, and most especially power laws. VCs make money in two ways. For assets under management, AUM, VCs earn a small percentage in a yearly fee, typically 2%. This pays salaries and other costs because startups take so long to pay off. VCs return cash or stock to LPs once the startups they backed go public or are acquired, years after the initial investment. VCs take 20% of the profits, called carried interest. Carry derives from shipping, where captains would take a profit share from the goods they carried. If I lend you $100, how much should you expect back in a year? The U.S. risk-free rate for bonds backed by the U.S. federal government and thousands of nuclear weapons is currently 3.88%. The bonds are liquid, as are other assets like public stocks, which means you can sell them at any time. The long-term rate for the S&P 500 averages 7.38% after inflation. Investments in startups are illiquid for years. That means the rate of return should be higher. This percentage growth yearly is called the internal rate of return, or IRR. Over 10 years, IRR averages compound into large multiples. 8% is 2.16x, 9% 2.36, 10% 2.59x, and so on. This means a whole fund must return multiples of the original to justify the illiquidity. Actually, many funds do worse. The graph below shows the top and bottom quartile of fund IRR by the year the fund started, showing that some years the bottom funds return less than what was invested. Each VC fund will make dozens of investments, but only a small share of those investments will impact the total returns. This isn't intuitive because power laws don't match a lot of things in the world. One home on a block isn't worth all the rest combined. One person in a crowd isn't as tall as the rest combined. But for VC portfolios, it isn't unusual for a single investment to be worth all the other investments of the fund combined. Let's illustrate with an example. Accel invested $12.7 million for 11% of Facebook in 2005, valuing the company at $115 million. In 2010, they sold 20% of their stake at a $35 billion valuation worth $500 million. The full stake was then worth $2.5 billion, meaning the investment already returned 200 times. In 2012, Facebook IPO'd at $90 billion, earning another $4 billion for Accel, totaling 350x returns. This means the original $440 million Accel Fund 9 returned 10x just from Facebook. That's 26% IRR from a single investment. From the graph of fund distributions before, this single investment made the firm a top performer. It literally doesn't matter what happened to all the other investments. The fundamental conclusion here is that the very best investments a VC makes matter, but all the rest don't. This means every single VC investment must have a chance to be at the top. See this illustrated here, where the fund on the left has a bigger head of the power law, but the fund on the right has fewer zeros, with more companies returning 1x or 2x. Fewer losers might seem better, but the fund with a better head of the power law is worth twice as much. To get VCs to invest, you need to convince them there's a chance your startup will be the best investment they ever make. Because startups take years to take off, investors need to predict the distant future. The best evidence of future stellar performance is past performance, meaning traction to date. But what might predict more traction? Early on, you might just have an idea and a team. Here are the dimensions to consider. Team. Who are the founders and the early team members? Where have they worked or gone to school? What have they built in the past? Do they seem relentlessly resourceful? Technology. What technology is required? Is it unique to the company? What work is ahead or already proven? Market. How big is the market? How big will it be? How fast is it growing now? Is the current shape fragmented, a large incumbent, or something else? Traction. Is your product available? How much money are you making? How many people are using it? Do they love it? Go to market. How will you reach your customers? How much will it cost? How fast can you grow? Who is the buyer? Are there regulatory hurdles? Culture. What makes your company unique? How will you keep your culture strong? Competition. Are there other players, large or small? What advantages or disadvantages do they pose? Why now? What has changed that means your startup can succeed? Why have others failed before? Here are some red flags to watch out for within these categories. If your startup suffers from them, try to solve the problem or at least have a good answer. Team. No one is technical. Everyone is part-time. Technology. Tacked on trendy buzzwords like AI or blockchain. Outsourced development. A hammer in search of a nail, like a grad student that just finished a thesis and is now looking for an application of the technology. Market. Contingent growth, where your customer growth isn't guaranteed, like making battery management software for satellites. Substantial regulatory barriers. Traction. Shy or uninformed on metrics, showing cumulative metrics instead of rates of change. Graph manipulation, like compressing the x-axis to seem faster. Or look at the actual labels, where you can have a product nobody's using, start having some engineers use it, and have a partial week of growth, or having a full week of user growth, which will actually look exponential, and I've seen this graph before. Go to market. We spent $0 on marketing probably means you don't understand the cost of different channels. Modeling customer acquisition cost as decreasing substantially over time. Not being metrics driven. Founders who want to hire a head of sales before establishing repeated sales models. This is symmetric to no one being technical. Culture. Maybe you're playing house, not working long hours, and especially anything dishonest or low integrity is a red flag. Competition. Inaccurately portraying your competition as hapless, unloved, and expensive. There's a lot more to say about this, but I hope this is a good introduction. In future posts, I'll write more in depth about VC economics and pitching. Subscribe to get future posts. Thank you.